Right now is the Wall Street Journal's chief economics correspondent. He is the author of Trillion Dollar Triage. Nick Timiraos is with us. Nick, it's good to see you. Thanks so much for being here.
Thanks for having me, Maria.
So Thomas Honig talking about something that we talked with you about the last time we spoke with you. Dagan brought it up a number of times, and that is shrinking of the balance sheet. We know we're going to get a 75 basis point hike today is likely, but what is your take about this worry over the Treasury market liquidity tightening up with the Fed shrinking the balance sheet, $95 billion a month, taking over $1 trillion out of the system? Is that going to create dislocation for markets over time?
You know, it's a good question. There's just not a lot that we know about how the balance sheet works on the economy, because this is something the Fed hasn't normally used when they're tightening policy. It's sort of an artifact of all the bond buying they did. They increased the balance sheet after they had cut interest rates to zero, and so now they're running it down. But this is only the second time they've done something like this, so we're kind of learning as we go. And the real focus is on what they do with the Fed funds rate. How much will they continue to raise it? Because that is what they've said they want the primary policy tool to be. They really don't want people to be focusing on what are they going to do with the balance sheet at any particular meeting. So that's on cruise control, Maria. That's sort of set it and forget it. And if they need to change what they're doing with interest rates, if they start cutting, in a couple years, then they'll look into what they're doing with the balance sheet.
Well, I'm glad you said a couple of years, because this debate that we're going to see, this sudden pivot, is so crazy. You write in the Journal, debate over how much more to raise rates could intensify as they reach levels more likely to restrain spending, hiring, and investment. Nick, some officials have said that they're looking to start reducing the size of the rate hikes after December. How important is what Powell says at 2:30 today in terms of suggestions about what happens after November? Do you think that we're going to see smaller hikes December and perhaps in March?
Well, Maria, if you look at the interest rate projections, the so-called dot plot that the Fed officials put out at their September meeting, it's pretty clear that they don't plan to raise interest rates by 75 basis points forever. Those projections, which are now 6 weeks old, showed that most officials thought they'd raise rates by another 125 basis points this year, and by 25, maybe 50 more next year. So that translates to the 75 that they're going to do today and 50 in December. And so the question is, are those projections still relevant? Are they stale? Has the high inflation reading from the September CPI, continued strength in the labor market, corporate earnings showing consumers are spending quite well? We have a very resilient private sector right now. And so the question is, do they still plan to step down to 50 in December, which was what they had sort of inferred from those projections at their last meeting? That's what I'll be listening for today. And I'm not sure what Powell's going to say. I'm not sure he has to say anything, because there is more data they're going to have before that December meeting. I think that the issue here is, the Fed has been speeding down the highway as they raise interest rates. And when you start to think about getting off the highway, you're going to want to slow down a little bit. You don't want to cut across 4 lanes of traffic. Yeah. So what we're talking about here with the step down to 50 is really, will they use their turn signal here?
Dagan.
Yeah, I clearly am not an economist because I don't drive that way. I'm going on the off-ramp doing a solid 60. I joke.
Yeah.
I want to ask about the rally and the exuberance of investors, particularly in October, because we saw that play out over the summer, where there was, again, hefty buying, exuberance, maybe a little bit of a speculative fever during the summer in anticipation that once again the Fed would, whether it's take a pause, even pivot. How does the Fed view that kind of rally in assets? Can you give us some insight into that? Does it factor into what they not only say today, but might do in the coming months?
Dagan, it's a great question, and it very well could, because the Fed right now wants to keep financial conditions tight. The whole point of raising interest rates is to tighten financial conditions. You're raising mortgage rates, corporate borrowing spreads, asset prices going down, the dollar strengthening, you're slowing interest rate sensitive sectors of the economy. And so if financial conditions ease, that is counterproductive. That is not what the Fed wants to see right now, if it's a sustained or dramatic easing in financial conditions. Someone said to me that trying to keep the S&P under 3,600 right now is like holding a beach ball underwater. It just has this force. It just wants to pop up, right? And so that's the challenge here for the Fed, is how do you keep financial conditions tight? And talking about a pivot, you know, frankly, it's kind of confusing to me what people mean when they talk about a pivot, because there are three pivots. There's the step down from 75 to 50. Then there's, you know, at some point you're not raising interest rates anymore. That's the second pivot. And then the third pivot will be when the economy weakens enough that they're actually cutting interest rates. But I think some investors right now are jumping ahead from the first pivot and drawing a straight and short line to the third pivot, and that is not how the Fed is thinking about this.
So what's your timing on that? I mean, we've got the October ADP national employment report out this morning. Economists are expecting 195,000 private sector jobs added to the economy. We've got the October jobs report out on Friday, Nick. We have not seen an impact to the jobs picture with all of these rate hikes so far. When do you expect the jobs story to catch up with the rate story?
It's a great question, Maria. You know, I think if you had gone back to March and said the Fed is going to raise rates by around 400 basis points over the next, 8 months, and we're going to be sitting 8 months later and we're still going to have a historically low 3.5% unemployment rate, people would have said, I don't believe you at all. And so that's a challenge here, because what the Fed wants to do is to slow down demand for labor a little bit. Yesterday, we got the JOLTS report on job openings, and that showed that job openings went up in September. The Fed wants to see job vacancies declining, because that's a sign that labor demand would be slowing. And instead, what we got yesterday was a report showing a still very tight labor market. Now, these numbers can be noisy. They can move around month to month, but generally that's what the Fed wants to see. They want to see the ratio of job vacancies to unemployed workers, which was at 2 in July and which was at 1.7 in August. It went back up to 1.9 yesterday. They want to see that ratio move down closer to something like 1.2, which is where it was before the pandemic.
All right, we'll leave it there. Nick, it's always great to get your insights. Thanks so much.